The Federal Reserve System, often called the Fed, is the central bank of the United States. It plays a crucial role in maintaining a stable and healthy economy. The Fed's primary responsibilities include controlling inflation, maximizing employment, and moderating long-term interest rates. The Fed uses various tools to influence the economy, most notably setting the federal funds rate. This rate influences other interest rates, impacting borrowing costs for consumers and businesses. Through its actions, the Fed aims to create a balanced economic environment conducive to growth and stability. Its actions can have significant global implications, affecting international trade and financial markets. It is a powerful institution with the ability to shape economic outcomes. The Federal Reserve's recent decision to cut interest rates by 50 basis points is a significant move. This substantial reduction signals a proactive approach to managing potential economic headwinds. This adjustment has immediate implications for various sectors of the economy. Lowering interest rates encourages borrowing and investment, boosting consumer spending and business expansion. This significant rate cut demonstrates the Fed's commitment to maximizing employment and controlling inflation. The 50 basis point rate cut has a direct impact on the housing market. Lower interest rates translate to lower mortgage rates, making homeownership more affordable. This can stimulate demand, leading to increased home sales and higher property values. Existing homeowners may refinance at lower rates, reducing monthly payments. The overall effect of lower rates is typically positive for the housing market. However, increased demand can lead to rising home prices, challenging affordability. The stock market's reaction to the rate cut can be complex and unpredictable. Lower interest rates can make stocks more attractive to investors compared to bonds, potentially leading to higher stock prices. This is because lower rates reduce the return on bonds, making stocks a relatively more appealing investment. However, a rate cut can also signal concerns about the economy's health, which can sometimes lead to a decline in stock prices. Investors may interpret the rate cut as a sign of economic weakness, prompting them to sell stocks and seek safer investments. This creates a mixed bag of potential outcomes. The stock market's response will depend on a variety of factors, including investor sentiment, economic data, and corporate earnings. Positive economic news can bolster investor confidence, leading to higher stock prices. Conversely, negative news can dampen enthusiasm and lead to lower prices. The interplay between interest rates, economic outlook, and investor sentiment ultimately determines the stock market's reaction to the rate cut. It's a complex dynamic with no guaranteed outcome. Careful analysis and understanding of market trends are crucial for navigating this uncertainty. Section 5. Job market implications, a balancing act. The rate cut can have both positive and negative effects on the job market. Lower interest rates encourage businesses to invest and expand, leading to job creation. This is a positive outcome. But if seen as economic weakness, businesses may be cautious. This can slow job growth or cause losses. The impact depends on business interpretation. The Fed aims to stimulate activity and support job growth. Lower borrowing costs incentivize investment and expansion. This is the intended effect. The job market's response will unfold over time. Section 6. Historical context, lessons from the past. Examining historical patterns of rate cuts and their impact on the economy can provide valuable insights. Past experiences can offer lessons about the potential effectiveness of rate cuts in stimulating economic growth and mitigating recessions. Historically, rate cuts have often been used as a tool to combat economic slowdowns. By lowering borrowing costs, the Fed aims to encourage investment and spending, which can help to boost economic activity. However, the effectiveness of rate cuts has varied depending on the specific economic circumstances. In some cases, rate cuts have been successful in averting recessions and promoting economic recovery. In other cases, rate cuts have been less effective, and recessions have occurred despite the Fed's actions. The historical record provides a mixed bag of outcomes. Analyzing historical data can help policymakers understand the potential risks and benefits of rate cuts. By studying past experiences, the Fed can make more informed decisions about how to use monetary policy to achieve its objectives. History provides a valuable guide, but each economic situation is unique. Section 7. Recessionary risks, a delicate balance. While rate cuts can stimulate economic activity, they can also carry certain risks. One potential risk is that lower interest rates can lead to excessive borrowing and increased levels of debt. This can create vulnerabilities in the financial system. Another risk is that rate cuts may not be effective in stimulating the economy if underlying economic conditions are weak. If businesses and consumers lack confidence in the future, they may be reluctant to borrow and invest even with lower interest rates. This can limit the effectiveness of monetary policy. The Fed must carefully balance the potential benefits of rate cuts against the potential risks. Lowering rates too aggressively can create imbalances in the economy, while not acting decisively enough can allow economic weakness to persist. Finding the right balance is a delicate task. The Fed's decisions are based on a careful assessment of economic data and market conditions. It constantly monitors the economy and adjusts its policies as needed to achieve its dual mandate of maximizing employment and controlling inflation. The goal is to promote sustainable economic growth while mitigating potential risks. Section 8. The consumer's perspective. Spending and saving. The rate cut can have a significant impact on consumer spending and saving behavior. Lower interest rates make it cheaper to borrow money, which can encourage consumers to make larger purchases such as cars or homes. This can boost consumer spending. Lower rates also reduce the return on savings accounts and other interest-bearing investments. This can discourage saving and encourage consumers to spend more of their income. The overall effect of the rate cut on consumer behavior is complex. Consumers may choose to use the extra money from lower loan payments to pay down debt, increase their spending, or save more. The specific choices consumers make will depend on their individual financial situations and expectations about the future. The impact of the rate cut on consumer spending and saving can have broader implications for the economy. Increased consumer spending can drive economic growth, while reduced saving can limit the funds available for investment. The Fed monitors consumer behavior closely when making monetary policy decisions. Section 9. International implications, a global perspective. The Fed's rate cut can have significant international implications. Lower interest rates in the United States can make U.S. assets less attractive to foreign investors, potentially leading to a decline in the value of the dollar. This can affect international trade and investment flows. A weaker dollar can make U.S. exports more competitive in global markets, potentially boosting U.S. economic growth. However, it can also make imports more expensive for U.S. consumers, potentially leading to higher inflation. The international effects of the rate cut are multifaceted. The rate cut can also influence monetary policy decisions in other countries. Central banks around the world may choose to lower their own interest rates in response to the Fed's actions. This can create a ripple effect throughout the global economy. The interconnectedness of global financial markets means that the Fed's decisions have far-reaching consequences. Understanding the international implications of monetary policy is essential for navigating the complex landscape of the global economy. Section 10. Long-term economic outlook, a path to stability. The long-term impact of the rate cut on the economy will depend on a variety of factors, including the overall health of the economy, the response of businesses and consumers, and global economic conditions. Predicting the long-term effects with certainty is challenging. The Fed's goal is to promote sustainable economic growth and maintain price stability. By carefully managing monetary policy, the Fed aims to create a stable economic environment that supports long-term prosperity. This requires ongoing monitoring and adjustments. The rate cut is just one tool in the Fed's arsenal of monetary policy tools. The Fed can also use other measures, such as quantitative easing and forward guidance, to influence the economy. The choice of tools depends on the specific economic circumstances. The long-term economic outlook will depend on the interplay of various economic forces. The Fed's actions, combined with fiscal policy decisions by the government, will shape the path of the economy in the years to come. Careful management and coordination are crucial for achieving long-term stability. Section 11. Conclusion. Navigating the economic landscape. The Federal Reserve's decision to cut interest rates by 50 basis points is a significant move with potentially far-reaching consequences. The impact on the housing market, stock market, job market, and the broader economy will unfold over time. The rate cut is a response to current economic conditions and reflects the Fed's commitment to its dual mandate of maximizing employment and controlling inflation. The decision is a calculated move aimed at stimulating economic activity and mitigating potential risks. The effectiveness of the rate cut will depend on a variety of factors, including the response of businesses and consumers, global economic conditions, and the overall health of the economy. The Fed will continue to monitor the economy and adjust its policies as needed. Navigating the economic landscape requires careful analysis, informed decision-making, and a willingness to adapt to changing circumstances. The Fed's actions play a crucial role in shaping the economic outlook, and its decisions are closely watched by market participants and policymakers worldwide.